what's the future of SaaS? Valuations have come down to earth, and we were hoping that was the end at the beginning of the year in 2025, and that valuations would stabilize. But then what happened is actually they didn't, and they continued their decline, and justifiably, because growth in SaaS has underwhelmed, and therefore these stocks have been repriced for slower growth. There's a number of factors behind it. One is some kind of saturation, probably, with the tools, and fatigue, because you have so much SaaS. Everyone, all the corporates, they subscribe to so much. AI is not helping because you can build your own tech. And also, smaller companies can launch much more easily, but also large companies, they fight with each other because they find it so easy to replicate other product functionalities. So it's all driving competition in this space, and that never helps. We had an interesting artifact that in private M&A deals, we've seen an uptick. My hypothesis is that that is because there's a small sample, not that many deals, and mainly the highest quality companies get sold. But what we see in the lower middle market usually is that valuations remain depressed, and we don't see any sign of improvement. On the higher end, I mean, the high quality companies are on the forefront of adopting AI, so they get a bit of that premium from AI valuations. But otherwise, I mean, we're seeing this sector being repriced quite substantially in the last few years, and probably gonna continue. And I think in a year or two, I mean, if they turned a profit, most of the listed SaaS companies, we would be probably talking about EBITDA multiples, like for mature company, for IT services. But it's still hard because a lot of these companies are not making any money. So we're using revenue multiples. Definitely after the bubble pops, I think we will see another adjustment. Now we can move on to the next slide. We had a webinar, you can take a look a few weeks back about how to position yourself, your SaaS business in this AI disruption. And we had this matrix of businesses that are less prone to disruption and more prone. It's important to understand where you are on the technical complexity and scale, and how close you are to the customer really, and how mission critical and sensitive your project is. If your customers needed the data is sensitive, you're probably safe. So you're in the zone for low risk. But on the other extreme end are applications that are simple to replicate, not mission critical, the data is not sensitive, that are definitely struggling. So we're seeing this trend, and we're expecting it to continue. So if you're in businesses that are high risk, like marketing, sales support, customer service, definitely worth considering options and revisiting strategy, because it's probably not going to get easier, and you have to either cut costs or sell or do both. Probably best to cut costs and then sell. If you're lucky enough to be in the low risk SaaS segments, probably gradually adopting AI and is enough to stay afloat and maintain a business. So these businesses will probably be not affected by disruption. So you might want to revisit one of our previous webinars. Okay, so valuations, and similarly to IT services, we're seeing a strong divergence of very high selectiveness of investors when it comes to KPIs. Probably the most important KPI we look at is at the bottom of this table. So the churn rate, which is the biggest predictor of whether the product is indispensable for their customers and they're happy with it, or if it's nice to have, or it's not relevant anymore. We see that businesses that have annual churn rate of more than 30%, they're really tough to sell. Anything less than 10% is great and commands a premium. So that's probably where we start most of our conversations with SaaS companies, to understand there are ways to reduce churn. obviously. So optimizing and preparing for sale, that's probably where you should start. There's a big difference. The second factor is size that drives valuation between companies that are 1 to 5 million in ARR. There's a big gap between those and those that have 10 million revenue plus. The investors are completely different. The way they interact, how strongly they are interested in these acquisitions. So definitely worth to grow to get to that threshold. If you have the path to get there, it's better to focus on that than sell prematurely. Revenue growth still important, probably more important than profitability. We haven't seen that the weights change in most of our conversations. Rule of 40, we were thinking to announce Rule of 40 dead, but it's still a helpful metric to understand the overall performance. I mean, a lot of people still use it. But if you look at, actually, we did that analysis of listed companies, very few SaaS businesses meet the Rule of 40, the large ones. But for smaller businesses, it makes a ton of sense. And the last factor that is important is how effectively you use your marketing budget. So lifetime value to customer acquisition cost. Businesses below three times LTV to CAC, very tough to sell. 3 to 5 is fine, but not very exciting. Everything above 5 is good, and 10 is excellent. So that's our take on the market. We see much higher valuation sometimes than we quote here, so it's always individual, sometimes lower. So I think that really recaps where we see the market today. And what, did we arrive at the end, Philip?
Yes, summary now.
So we talked today about AI that is really driving everything that's happening in tech M&A. And he has been doing very well in last year. I think from this exchange with our participants, I'm coming back with a conclusion that we still have a bit of runway ahead of us, and the bubble will probably continue, and we might expect some shakiness towards the end of 2026, maybe, or 2027, or in 2027. So I think we can quite confidently say that we're in a bubble, but it's not time yet for it to burst. And obviously, I mean, it is very consequential for SaaS and IT services, what's happening in AI. So it's really putting a wedge between the winners and losers, and the ones that manage this well. I mean, first of all, the ones that have been positioned or picked industries that are less likely to be disrupted will benefit and will thrive in the long term. The ones who picked industries that are getting or sectors that are getting disrupted or need to adapt, basically, or they will be pushed out of the market from the AI, due to the AI revolution. So I think that's 2025 Tech M&A wrap. Thank you all for your participation and for your votes in our polls, and for the valuable questions. We'll be back in 2026 with new concepts, new webinars, and new valuable content for you to help you run your business and make M&A and investment decisions. Feel free to write to us, email us, reach out on LinkedIn. Happy to always have a chat. And we're wishing you, your families, your teams lovely holidays and a happy new year and a very profitable 2026. And hope you can ride whatever is happening in this turbulent time with success and with a steady mind.